What is going on? I hope everybody's having a great week. Welcome, my fellow income investors. Welcome to the channel. I am the covered call guy. And for those who are new, my goal here is to create $120,000 in annual passive income with currently holding 7 holdings: GPIX, QDevo, GPIQ, IWMI, SPY, QQI, IDevo, hence the name, the covered call guy. However, once I reach my goal or get close to my goal, I will be shifting and adding BDCs, CEFs, traditional dividends, stocks, again, single stocks, whatever it is. I will be diversifying a little bit more away from covered call ETFs. But at the meantime, currently, it yields me about 70 grand a year, 5.8K a month, 1.3K a week, 193 days, $193 per day, $8.05 per hour. All right, before we get started in this video, legal disclaimer: this is purely for entertainment and educational purpose only, not investment, financial, or tax advice, because I am not licensed, certified, qualified, or caffeinated enough for all of that. All right, all opinions are my own and may be wrong, misguided, or just straight up nonsense. Okay, I spew a lot of BS. So do your own homework, do your own due diligence, and talk to a real professional before making any money moves. Remember, I am just some random clown you found on YouTube. All right, with that out the way, let's get started on something that's been quite, starting to get popular, or they're starting to put out new ETFs, and it might reel in some people who are just getting into income ETFs. So let's talk about the 15% yield, possible yield trap. When we breaking down VistaShares of TEPRTantrum ETF, so you don't get wrecked. Hopefully, I explain it quite good enough. Break it down simple enough. Again, one of their most popular ETF is OMA, and they do try to copy Warren Buffett style. Well, no, Warren Buffett is retired, so they just try to copy whatever, I guess, Berg B's holding, right? All right, so what is TPRY and what it actually is? All right, so the specs is the ticker symbol TPRY, issuer is VistaShares, expense ratio is 0.95, which is kind of crazy high in my opinion, just to copy someone's portfolio, but that's just me. Launched, I believe, in February 26, 2026, so it's just about 5 seconds old. All right, so what is the pitch versus reality that they're giving you? So what is their pitch, right? So they do, in my opinion, they do want you to think you're investing exactly like the billionaire David Tepper, right, while collecting a massive 15% yield. It is an incredibly powerful marketing pitch to retail investors like myself and you, right? But what's underneath the hood, right? The structural reality is the absolute minefield, and that is the only thing you should care about. All right, so let's talk about the 15% illusion. The 15% illusion means annually they should target about 1.25% target monthly payout, right? So the 15% is completely manufactured. Okay, understand the difference, right? Manufacturers versus organic, right? Typically, organic is organic dividends that's paid out from profits, hopefully, right? Not a guarantee yield or a reflection of total return, okay? Meaning it could just be cannibalizing your NAV, your principal, right? So they're following Tepper's top stocks like Amazon, Alibaba, pay basically nothing in dividends. Okay, so to hit that 1.25 monthly hurdle, they are forced to take a little bit more extreme measures with your money. Essentially, how I got the 1.25 is 50% annual target divided by 12 months equals your target rate of 1.25 of NAV per month. Okay, let's look at layer 1 and the 13F lag risk. For those who are new to the channel, I did a kind of similar video on OMA, and basically, oh god, this video picture didn't load, but anyways, it's just a camera, a snapshot, right? And basically, you see half the picture, but yeah, that's kind of essentially what I'm talking about. Anyway, so layer 1 is the foundation of this fund, right? It tracks the 20 Appaloosa holdings via SEC 13F filings. But the ugly truth behind that is they are delayed by up to 45 days. So by the time they copy the trade, perhaps they already sold, right? So you're 45 days late, right? So you are perpetually buying the echo of a trade, right? They put it out 45 days late, long after Tepper or the team or the hedge fund has already moved the market. So by the time this ETF rebalances, you might be buying into his exit liquidity. So a lot of people don't mention that. They're not going to tell you that, of course, right? But why would VistaShare tell you that? So again, you are copying a very, very delayed trade. You can pretty much do it yourself here, but again, I understand I'm too lazy myself, so yes, I understand. All right, layer 2 is the options trap. Okay, so how do they layer this second layer that could be the options trap? Well, first is the writing options portion, right? To fund that massive payout, because at least my research shows that they systematically sell call options against the portfolio. I think that's true. All right, and then of course, basically collect the premium, which is your profits. That's how they distribute, right? When the market explodes upwards, your gains are mathematically capped for the most part, of course, right? Sacrificing explosive growth. You are here for the payout, not for the growth. All right, so this again leads to the capped upside, right? So you are essentially trading away your upside just to get your own money handed back to you. Again, it is 5 seconds old. We don't know if it's destructive or constructive rock. Of course, you should always assume the worst. That is part of my due diligence. I always assume the worst outcome. That way I have a nice buffer zone. All right, extreme concentration. So let's look at what they're actually holding, right? So 14% or 50, let's just say round it up to 15% of Alibaba, 8% of Amazon, 6% of TSMC, about 6% of Nvidia, and 6% of Corning, right? And the rest of the portfolio is 60%. So this isn't a diversified safe haven, right? 64% of your money is technically essentially locked up in high volatility tech and Chinese e-commerce stocks. Now, again, you might be like, this is actually diversified because I have no other international Chinese or whatever holdings and I might want that. Okay, that's fine. But I'm just saying, for the most part, we would not consider this diversified, okay? So ironically, the fund managers desperately need these massive price swings just to afford your option premiums. Hence why I think they're doing it this way, why they're actually issuing a copy of this, because I guess, international markets could move, especially with what's happening with the geopolitical environment right now. All right, the brutal reality of return of capital. Of course, we have to talk about this, right? So let's look at Darky, right? March 2026 rock payout is 100%, give or take, however you want to see it, good or bad, that's on you. TPRY, they're expected to be at least a 96%, ACI 96%, and OMA about 37%, right? So under section 19A, the fund have to disclose exactly where your cash comes from. Again, these are estimates. So in March 2026, about 96.84% of TARPy's payout was literally just destructive rock of return of capital. Again, I'm just going to put destructive because I'm assuming the worst, okay? I'm just going to assume the worst. They are about 5 seconds old. I'm just going to go ahead and say assume the worst. That way you have a buffer. So I'm just going to go ahead and say they are systematically liquidating your own principal to maintain the illusion of yield until we will revisit this 6 months later and see if I changed my opinion and my mind and make some corrections. But for my due diligence, for something this new, I'm just going to go ahead and assume the worst. Okay, NAV destruction scenarios. Again, this is a scenario, my scenario. So looking at it in a sideways market, which is the gray, right? This strategy actually shines, right? As options, of course, expire worthless. But in a bear market, the red here, you absorb about 100% of the crash. So looking at that prolonged bear market, even by year 3, you are pretty much hit at the 50% mark, right? I don't think that there's enough option premiums to buffer that. And then by year 5, you are completely done, okay? Your net asset value is permanently destroyed because remember, it's completely capped. Okay, the memification of alpha. So what do I mean by this, okay? VistaShares is brilliantly commoditizing your parasocial trust and legacy billionaires to create instant media hype. Hence why they're doing it for this. They're doing it for Darky. They're doing it for OMA, right? It is essentially, the way I see it, is just repackaging the same old theme-based ETF marketing we saw crash and burn in recent years. I'm seeing this as a kind of a meme following of Roundhill, perhaps YieldMax. I guess they're doing this type of memification in terms of copying. They're copycats type of trend. This is their specialty, I think. All right, so if David Tepper has one bad year, well, then the entire psychological allure of this fund vanishes overnight, right? So remember, Warren Buffett is their whole OMA thing was invest like Warren Buffett, But Warren Buffett is retired. Yes, now you're investing like his philosophy, but now his whole name is attached to it, and like a lot of things can happen when you attach just one name to this type of strategy. So beware of that. Hey, systematic portfolio risk. All right, I just want to put this out there. I think this can truly be one of the worst risks. So, concentration and non-diversification. So, as I mentioned this earlier, heavily tilted towards Chinese tech and U.S. semiconductors. So, a geopolitical flare-up involving Taiwan, of course, could destroy the NAB overnight, completely wipe this out. Right, high turnover risk. Again, this is extremely new. Right, so frequent quarterly rebalancing, 45 days delay, right, and continuous rolling of option contracts generate massive internal trading frictions and awful tax consequences. Remember, this is very new, so they have to really quickly grow their assets under management. All right, derivative leverage, right? So anticipated volatility spikes can rapidly change the pricing of short calls, creating losses that far exceeds initial premium collected. This is just one of the risks of all cover call ETFs, especially with very low assets under management. Of course, again, the fourth one is new fund risk. Formed in 2026 of March, right, and lacks any long-term track record demonstrating how it will survive a true liquidity crisis. So to be clear again, a recap here of a systematic threat that you are taking on, right? You are exposing yourself to very severe geopolitical crackdowns and leverage like volatility just for a target distribution. Again, a lot of it is heavily tilted towards Chinese tech, and anything can happen with the this administration and with the trade wars or whatever can go on. All right, so advanced structural risk. I do think of option sustainability, as you should too, when we are doing cover call ETF investing, right? Cover call stock investing. So maintaining 15%, which in my opinion shouldn't be hard, but this part is pretty unique because they are copying somebody, right? They're not doing an index base, right? Requires a perpetual high volatility regime. So they have to ensure that they are, the hedge fund is actually picking the right stocks, right? If the VIX compresses to a historic low, option premiums evaporate. So this is not new. This is pretty much to all cover call ETF investors like myself. However, this is very specific type of investing, right? They're a copycat. So to maintain the payout, the managers are forced to write at the money options, completely neutering your ability to participate in any market growth, right? So I'm not sure if they do any call spread strategy like NEOs or have an uncapped tactical override like Amplified or the Goldman. So this is something to think about, okay? And of course, the key person risk, right? So your entire investment thesis is basically linked to one person, right? It's David Tepper's public reputation and continued success. So if he retires or his family office stops following public 13S, well, then the foundational logic of the ETF completely collapses, right? If the market volatility drops to a historic low, again, option premiums evaporate, forcing managers to take a little bit more insane risk just to pay you. Plus, your entire investment thesis relies completely on one billionaire continue to file public paperwork, or if he just steps out or he does something crazy. People do go crazy, right? All right, so how to actually use it? I've been talking about the good, the bad. I've been talking about the bad and the ugly. Let's talk about how to actually use it. Some of the good, all right? I'll try to be non-biased here. So how do I actually use this without destroying my account, right? So what if I really like David Tepper and I just want to be able to copy even if I'm delayed by 45 days? So again, I'm going to say this is extremely new. These copycat styles I'm not a big fan of. So keep it strictly as a satellite position, right? Sizing no more than 1 or 3%. And if you're really a big fanboy, then 5% of your total investable assets, right? Pair it with a low volatility, high quality core holding like treasuries or dividend aristocrats. Like actually go ahead and buy the stock, maybe, perhaps, right? You don't want to actually just rely on, make sure it's quality, right? Amazon, right? To offset the aggressive beta that you will be receiving. All right, sustainability cheat sheet. Again, this is my take, okay? Please do not pair this with the NASDAQ 100. You will introduce a very severe redundancy and correlation risk. If you are an aggressive yield chaser needing immediate cash flow, then yes, TPRY is a fantastic tool, right? If you want a long-term capital preservation, I say run the other way, right? Aggressive yield seeker, recommend tactical allocator, recommend core holding, core equity holding, avoid capital preservation. I just don't see it right now. Avoid. Why? Because again, extreme concentration and capped upside ruin total return, and of course near 100% mathematical certainty of long-term NAV decay. Okay, my final verdict before I end it. Okay, I just want to say TPRY is a highly tactical income engine. Okay, it is great for those who understand the logic behind it. Yes, there are certain ways to play this. I don't think it's gonna be a long term. I think it's great for those who know how to play around the buy on and the low of these 13F filings, and they actually track the individual stocks. They actually track the geopolitical events happening, right? Not a buy and hold miracle, of course not. I've been saying this. It does belong strictly in your satellite allocation, right? Isolated from your core foundational wealth portion. That's my honest assessment here, right? I do respect the financial engineering that VistaShares is putting out, right? But you have to monitor this daily and do recognize the inherent decay. I do think that when you follow these type of copycat holdings, there is going to be a more serious risk. Even if, yes, OMA has been performing better than most, but just because it's been performing better than most and this type of environment doesn't mean it will hold up, because remember, you are copying somebody. That could essentially go very wrong, right? I mean, it's not an index based ETF, so just understand you are trading more of a long-term growth for immediate aggressive cash here. This is pretty much, even at a 15% yield, is quite aggressive. All right, so hopefully you got something out of that. If you did, again, if you're new, subscribe, comment, like, help me grow the channel, support the channel, and let me know what you want me to break down next in the comments. Appreciate you guys for watching. Stay tuned. Catch you guys on the next.